Welcome back, everyone. Let's talk about universal life insurance. In my opinion, if you can grasp the concepts behind universal life, you'll be well equipped to understand most other life insurance products. Universal life policies are designed to provide transparency and allow policyholders to participate in the insurer's financial experience. Instructor provides background on the development of universal life. Traditionally, whole life policies paid interest rates of 3.5 to 4% on the cash value, even if the insurer was earning 9% or 10% on their investments. Many policyholders started to question this practice and threatened to withdraw their cash value to invest on their own. This is known as disintermediation. In response, insurers developed universal life as an unbundled product. Instructor explains the unbundled nature of universal life. With universal life, policyholders can see the inner workings of the policy. They can view the mortality expenses, administrative costs, and interest earned on their cash value. This level of transparency was not available with traditional whole life policies. When an insurer earns 10% on investments, they might credit 7% or 8% of the universal life policyholder's cash value, rather than the 4% typical of whole life. Instructor draws a diagram to illustrate universal life. Picture a bowl that represents the cash value account in a universal life policy. Two things go into the bowl: premiums and interest. The interest rate credited to the cash value is called the non-guaranteed rate because it can fluctuate based on the insurer's investment performance. When the insurer does well, the policyholder benefits from a higher credited interest rate. When the insurer underperforms, the credited rate may be lower, but never below the guaranteed interest rate. The minimum guaranteed interest rate is often between 3.5% and 4%, below which the credited rate cannot fall. Instructor explains the outflows from the cash value account. Two things come out of the bowl: administrative expenses and mortality expenses. Administrative expenses cover the insurer's costs of doing business, like salaries, utilities, and supplies. Mortality expenses, also known as the pure cost of insurance, are based on the death claims experienced by the insurer for a particular risk class. Instructor provides an example of how mortality expenses work. Let's say Pearl is in a risk class with thousands of other 30-year-old preferred non-tobacco female insureds. If 220 of those insureds die in a given year, with total death benefits of $10 million, that cost is spread across the surviving policyholders in the form of mortality expenses. The insurer collects small amounts from each policyholder to cover the expected death claims. Instructor discusses the flexibility and risk of universal life. The interest rate credited to the cash value can change monthly based on the insurer's performance. This makes universal life riskier than whole life, which offers more stability. If the insurer experiences high expenses and low investment returns, they may need to increase premiums to keep the policy funded. On the other hand, if the insurer performs well, they could potentially decrease premiums. Instructor explains the range of premium payments. Universal life policies offer a range of premium payment options, from a minimum premium to a maximum premium. Paying the minimum premium can be risky, as the policy may lapse if the cash value is depleted by expenses and cost of insurance. I generally recommend clients pay the target premium, which is based on actuarial projections of what is needed to maintain a healthy policy, given certain assumptions about expenses and investment returns. Some insurers are so confident in their target premium that they'll guarantee the death benefit for a certain period, even if their assumptions prove inaccurate. Instructor highlights the flexibility of universal life. One of the key features of universal life is its flexible premiums. Policyholders can choose to skip a premium payment, pay more or less than the planned premium, or even stop paying premiums altogether, as long as there is sufficient cash value to cover the policy costs. This flexibility can be attractive to policyholders with variable income or changing financial needs. Instructor introduces death benefit options. Universal life policies typically offer two death benefit options. Option A, also known as Option 1, provides a level death benefit equal to the face amount. As the cash value grows, it does not affect the amount paid to the beneficiary upon the insured's death. Option B, or Option 2, provides an increasing death benefit. The death benefit is equal to the face amount plus the accumulated cash value. If Pearl has a $450,000 policy and dies when the cash value is $48,000, Dawn would receive $498,000 under Option B.
So option B is kind of like the face amount plus cash value rider we talked about with whole life, right?
Exactly, Dawn. The concept is very similar. Let's move on to the corridor of insurance, also known as the risk corridor. Instructor provides an analogy. Have you ever played with magnets, trying to push them together, but the magnetic fields resist and push back? That's a good way to visualize the risk corridor in a universal life policy. Instructor explains the risk corridor concept. The risk corridor applies to Option A policies. As the cash value grows, it's important that it doesn't exceed the face amount of the policy. If it does, the policy may become a modified endowment contract, MEC, which has negative tax consequences. To prevent this, insurers automatically increase the death benefit to maintain a corridor between the cash value and the face amount. The cash value pushes up on the death benefit, like two magnets repelling each other. Instructor discusses the purpose of the risk corridor. Instructor: the risk corridor represents the pure amount at risk for the insurer, the difference between the death benefit and the cash value. If the cash value grows to equal the death benefit, the policy wouldn't really provide insurance anymore, as the insurer would simply be returning the policyholder's own money. The IRS requires insurers to maintain a risk corridor to qualify for the tax advantages of life insurance. The exact size of the corridor is determined by a complex calculation specified by the IRS. Instructor introduces the concept of non-traditional policies. It's important to note that universal life is considered a non-traditional form of life insurance. Traditional policies include whole life, endowment, and term insurance. Another non-traditional policy type is interest-sensitive whole life, also known as current assumption whole life. With interest-sensitive whole life, the cash value growth is influenced by the insurer's current experience with investment returns, mortality costs, and administrative expenses. If the insurer has a particularly profitable year, they may credit extra interest to the policyholder's cash value. This is different from traditional whole life, where the cash value growth is predetermined and guaranteed, regardless of the insurer's actual experience. Instructor compares traditional and interest-sensitive whole life. With traditional whole life, policyholders can see a table of guaranteed cash values for each year of the policy, all the way up to age 100. These values are not affected by changes in market interest rates or the insurer's performance. Interest-sensitive whole life, on the other hand, offers the potential for higher cash value growth if the insurer performs well, but also carries more risk if the insurer underperforms. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 17. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 17. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 17. Good luck and keep up the great work.